Welcome to episode 57 of Accessible Finance, where we demystify personal financial topics and answer your questions so you leave saying, I get it now. I'm Eric Johns.
I'm Rachel John.
Let's dive in.
All right. So, Eric, I've been scouring all things kind of related to financial everything.
Great.
Yeah.
Good.
Yeah. I like to see where the tide's going, where the wind blows. So there's been I do.
Got it.
I'm keeping a finger on the pulse of
Got
the
it.
financial scenarios and needs. I'm
That's
doing
good.
great. You're welcome.
Reminds me of Georgia Klepper. Go on. Sorry.
We love you. Okay. So there was a person who had posted something about, they were semi-professional like poker player or something like that. And so he was basically just like, I've never been one to plan. Like I just hope
Wing it.
yeah,
For the
exactly.
best.
I'll wing it. So
Old strategy cotton. Let's see how it plays out for him.
indeed. So I thought that we would use this episode to really talk about kind of that strategy, that mentality.
Of what? No strategy? The strategy of no strategy?
Well, sometimes the strategy of like, I believe I have a strategy, but that strategy is in like essence not really a real
Okay.
strategy.
Let's do it. I
So
like
I
it.
think that it's really clear that obviously going and like playing blackjack is probably not the best retirement plan,
Sure.
but there's a lot of other concerning things between that and a true retirement plan.
Okay.
So it's essentially I want to call this one retirement roulette. Okay. Are you
Got it.
betting on a winning strategy?
Okay.
So retirement's essentially like a trip to the casino. But instead of hoping for a big jackpot at the end, our goal is to really end up not going broke,
Okay.
right?
Yep.
So there's this idea of making sure that the retirement plan that we have is an actual retirement plan.
Right.
So, I imagined roulette like guessing at the stock market game and trying to pick the stock that you think
Okay.
is just gonna hit it, or relying only on like Social Security as your retirement plan, right?
Got it.
Roulette seemed like a fair.
To Social Security?
Well, Social Security as your only source
If your
to
spending's low
your
enough, I can get
retirement plan.
behind it. It just depends.
Oh, okay, fair,
I mean, if I spend 30K a year and my Social Security is 50K a year, it's inflation adjusted, I'm probably all right with that.
I'd be impressed if you spent 50K a
I
year.
mean,
That's a pretty
I'm not,
tough
but there are people that do such a thing.
True, but
They're just not
they're
me.
far and few between, I think. Okay, so slot machines
Yep.
being like randomly contributing to savings without any kind of consistent strategy, hoping for like a windfall in the future, or banking on like a retirement coming your way or something like that. Right? Like I just feel like this month I'm just going to contribute $100 to my savings account.
I mean, I agree that they're both equally nonsensical. Go on.
Yes. Okay. Beautiful. And then the poker being the risk of betting on like one big hand, like putting all of your savings into Nvidia.
Okay.
Okay. So typically when you are going and betting or anything like that, right? They say the house always wins.
Okay.
Okay. So in retirement, the house is inflation, bad planning, unexpected expenses.
Okay.
So we know those things are coming.
Mm-hmm.
But the good news is your ace in the hole is your financial professional you're working with,
Okay.
right? So
We're going
I
hard here.
think that, well, I think it's really important because I saw a lot, and I'm going to talk a bit about this, of people who were convinced that they had a really solid retirement plan. And
Okay.
it was all an Ask Reddit, and there were tons of horror stories about people who had a plan, went into it convinced that they were fine, and then things happened that we can count on happening, like inflation or
Recession. Yeah.
emergency. Exactly. And then that plan went out the window
Got it.
and they were left with nothing. So, let's start just by like quickly going over why some of the things we talked about are not great ideas. Like,
Okay.
why would betting everything on one stock, one company, one financial product, why is that suboptimal?
It depends on the financial product. Sorry, but I'll try not to give it depends answers. Just know that it
Okay,
will.
so like I think it's
Like an annuity, like going all in on a single premium immediate annuity is so different than like all in Nvidia. Like the
agreed.
variance there is like astronomically different. Like one is like the opposite end of the spectrum of like certainty versus non.
Okay.
Does
So
that
do
make
you
sense?
want to remove the annuity from the discussion?
No, we can't. Okay, so if we're just talking like a single equity versus like a globally diversified portfolio.
Correct. Or even a single company, right? Like there might be a company that has multiple,
Well,
like like a
oh, like
parent company, right?
like a sure,
But
like I'm
even
with
if
a
you're
private employer and I'm going to go all in on private employer stock.
exactly.
Yeah, that's something.
Correct. So, but these are options where somebody might see that something has done well, or they
Right.
heard a story, or they know
Yes, yes,
someone
yes,
who
yes.
struck
We
it
hear this
big.
regularly.
Correct. And I think that if you have someone that you trust or that you like, or someone who has been successful with that strategy,
Mm,
luckily, telling you like, hey, get in on this. It's a good thing. It's
sure.
really, really hard.
Sometimes it can be your boss. Sometimes it could be,
Yes.
executives at the company that you maybe work for and you maybe love the
Correct.
company and they're offering you in on private equity or something like that.
So
Or
what are some of the risks in going all in on one investment?
there is no safety net unless you're a big bank from going completely belly up, right? So your stock can just vanish overnight. I'm trying to think. Bed Bath and Beyond,
That's a good
probably
one.
one of the most recent. There
I
are a
missed
number of
them.
others. I mean, Enron's one that's a classic example. Kodak was once like a top 10 company in the S&P. Like, what many of you have bought Kodak stuff recently? That
Exactly.
company
And
might still exist. I think it
depending
was
on how
bought.
young you are, how many of you have heard of Cook?
Exactly. Like like that happens.
That's
Like
true.
GM is
Yeah.
another fall from grace. It still exists as a company. It still exists and it's done
You've heard of them,
infinite
you know them.
spin-offs and acquisitions and they're trying to do things right. But like that isn't they used to
The
be a
powerhouse status is not
conglomerate,
there
not
anymore.
so.
Yeah.
And if you were in there, if you bought into them at their peak, you would have lost like 80% of what you had.
Yeah.
So yeah, if you're all in on one company, your results are just exclusively tied to that company. You're
Yes.
not diversified. And really the biggest thing that we would say is like the only thing that the closest thing to a free lunch in finance and economics is diversification. What that means is you can achieve superior risk adjusted results on a consistent basis by diversifying. What that means is we want assets with positive expected returns. So we expect them to go up, not by the same amount, right? And then they need to not be correlated one to one.
Yeah.
Okay. So not one to one correlation. And then assets that are expected to appreciate, and you will actually have less risk overall. You can lower the standard deviation as a proxy for
Mhm.
measurement of risk of the total portfolio by just buying a variety of equities that have positive expected returns, not perfect correlations.
Correct.
Like ideally, it's like negative correlations, right? Or like not significantly positive. The less positive, the better. But even if
Sure.
you're like, even if it's like, zero point 0.9 correlated, right? So
Mhm.
the correlation scale is like 1 to -1. Anyway, if it's very highly correlated, like zero point 0.9, you're still achieving a superior risk adjusted
Yeah.
result by buying into two stocks instead of one. Sorry, that was,
I think it's
I get
important.
mired in the weeds.
Yes.
It's my favorite
But
place.
I think it's important to note that, like, there are resources out there to help you look at how things are correlated or how
Oh,
truly
yeah.
diversified your portfolio is. It's not something
Use
that you should just inherently know.
No, no, no. Look at Portfolio Visualizer.
Correct.
It's very good.
Yeah,
They have a free version of their site, and it's still useful. It's very useful. You
yeah,
can look at asset correlations there.
exactly.
You can back test portfolios. It's a useful site.
Correct.
Very useful.
And if you're working
Visualizer.
with a financial planner or financial professional, they should
Yeah,
be
they'll do
able
stuff
to
like that.
provide all of that information and visuals and things that could help you to see how truly diversified your portfolio is.
Correct.
Okay,
So all in on one stock
so
could lose
that
everything.
is
Not great.
exactly. So that's one type of like
Yep.
retirement gambler. The second type might be the work forever gambler, right? The one that's believes themselves to be able to work
Yeah.
until the day that they die. There nothing is going to happen to them. They're not going to get sick. They're not going to have to go on any type of disability. Like they are good to go.
My dad very much exhibited this
Yeah, that's true.
characteristic.
His thought
He
of doing it.
thought that, hey, if I made 150K in one year, all I have to do is work again, I'll make 150K. That's not how this works.
Yeah.
No.
Yeah.
It turns out that not everyone's just going to pay you what your last salary was plus inflation. That's
Correct.
not how it
It
goes.
also relies on like no unexpected health or life changes,
Sure.
or depending upon what sector
Yeah,
of
your
business
industry
you're
could
in.
just be in decline, right? Like maybe
Exactly.
you're working in oil and gas, and then
Mhm.
like we
We find
electrification of
alternative,
the
right?
grid, and now all driving electric vehicles. The demand for oil's down. Like you get laid off.
You just don't know. And
Yeah,
so, while if you're the person who wants to work forever or loves your job, that is amazing. It's not a retirement plan.
right.
It's an excellent plan B, E, F to support said retirement plans.
Sure.
But to say that, I'll be fine, I don't need to worry about retirement, I'll keep working, it's risky. It's really risky.
Right.
Um, there's also, I mentioned earlier, and you were like, well, it depends. And I think you're right here, but the sole reliance on Social Security to cover all of your retirement expenses.
I would I would say that I believe personally speculative, like Eric Johns
Yeah.
thinks on a personal level, and I'm not advising clients in this way, that it's likely that Social Security will at least be pared back
Yeah.
and pared down in some way. Maybe it's going to be means tested. Maybe it's just that they just lower it. Maybe they never inflation adjusted. They're probably not anyway.
We
But
talked about not relying on that for us personally. Like when
oh
we,
yeah, yeah.
yeah,
Most younger clients, we would say, bank on like 80% of Social Security, maybe less, right? Like you're gonna want to pare that down a little bit because the government's gonna run into some turbulence
yeah.
in the not so distant future, right? Just it's ballooning out of control, right? The costs of administering the programs,
Hmm.
the social programs that we have currently are ballooning to a point where it's not sustainable. So they've got to do something. It might not be Social Security that hits. Maybe just Medicare takes the brunt of it, but we would expect that they'll probably,
Something. Well, and
they're gonna have to
even
wheel and
if
deal and
nothing happens to Social
slice and dice.
Security, like in your scenario where you were like, your expenses might be 30K, your Social Security is 50, your expenses might be 30K now.
Right.
That could
You're gonna want
change.
some kind of an emergency fund. You're gonna want some
Yes,
kind of an equity or a portfolio that you can draw on in years where you need to spend
correct.
more money, right? Like maybe you get diagnosed with
Yes.
some very unfortunate medical condition
Yeah.
and you're, maybe in a Medicare Advantage plan or Medicare, I'm sorry, Medigap coverage or, Medicare supplement.
Something
You
called
might
Roulette.
have like you might be your prescription drug plan might not cover the
Hmm.
cost of the prescription that you've got because you have a rare illness, or they just, the pharmaceutical companies are happy to charge you with whatever you can
I
pay.
love
Yeah,
breaking out the insulin
right,
charges.
exactly.
Well, and I think it's if Social Security does not have to be your only retirement
That
plan,
is
it
exactly true.
should not be your only
Exactly
retirement
true.
plan.
Exactly correct. You should
Yeah.
definitely not think of that as your whole, support structure and cash
That's
flow.
I think essentially where I was coming from here is that
Yeah,
like
that's
there are people who are in a boat where like that is where your money is coming from. And
right.
if that's the
No,
case,
that's
that's that's a wonderful thing to have.
yeah.
But don't spend the difference between your Social Security and everything else you've saved because you're like, I have Social Security. Don't do that. Don't do that. Don't do that. Um, and so it's, life's kind of like, playing blackjack, but you don't know when the dealer's going to be like, all right, you're done. You're retired. You are no longer working. You don't know. You don't know what's going to happen. You don't know what the life situation is going to be. So that becomes really, really tricky.
One thing that's also just a brief comment there
Yeah,
is if you're working in a physical job, it's even more likely that you can't do that forever.
correct.
Like your body will slowly break. So if you
Mhm.
think that, I don't know, you're going to be like, I'm
You
not
know
sure,
that
I work
better
in
than any.
construction. Yeah. Unfortunately, yes,
Yeah.
mine has been breaking for a while.
Since,
Um,
yeah,
but I mean, rugby kind of
rugby
does
takes a
that.
toll.
But the point is, if you're working in physical labor, maybe you're making, high dollars, working on oil rigs or in the oil and gas industry in the oil fields or something like that, where you have to actually, be there doing things, lifting heavy objects. It's probably that you're probably not going to be doing that when you're 65 or 70.
Yeah,
Or if you are, you're going to be in some diminished capacity. Maybe you're a foreman at that point or you're overseeing projects and that's great. And then sure you can move. But the idea is if your job involves a high amount of physical labor, don't count on doing that forever.
agreed. Love that. And so to that end, I kind of wanted to give you the opportunity, or ask you really to elaborate on ways that um, a financial professional, and again, we're speaking specifically regards to CFPs and like what we would do, because we don't want to speak on behalf of the entire profession, but um, ways to kind of hedge those bets or those kind of like gambling strategies that we talked about earlier. So the first one, um, rather than the all-in investments, would be the diversified investments. You did elaborate
Yeah.
a bit on that as far as
Globally diversified
correlate, right?
portfolio. You want to have non-correlated assets, which usually means you want some percentage in bonds. We've heard the I don't want to say argument. We've heard people make the point, and they're correct, that in 2022 bonds went down. Some segments of the bond market went down more than the equity markets, right? So you could say like, wait, why do I have bonds as a hedge against equities if they're both going to just drop in parallel, right? Like in
Yeah,
unison. That's not exactly what I'm looking for, and there's a lot to speak to there. That I guess I don't want to derail us too much, but anyway, generally speaking, we would want to have a globally diversified portfolio that has fixed income in it.
well, exactly, and that's what I think it's important to note that bonds are not the only option for fixed income or that kind of.
The asset class diversification.
Correct.
Sure.
So, being able to balance um, the risks that you're taking to lower the overall risk is really the name of the game, right?
Absolutely.
Yeah.
You want to have superior risk adjusted returns. So if you can take, if I can have a 7% expected return with 10% standard deviation year over year versus a 7% expected return with 20% standard deviation, as a risk averse person, you should always want less. Like you should always want the 10% standard deviation. You should want less deviation in your results.
Correct.
Like if you could say, I'll give you, Eric, I'll promise you a 7% return with zero standard deviation. I would sign on the dotted line
Oh yeah.
all day, every day for
Guaranteed
the most part.
7% on your
Yeah.
home. Come on now.
And especially if we're talking like inflation protected, right? So
Correct.
the idea is that humans are naturally risk averse,
Yeah.
and so you were going to achieve superior results by just having a diversification across asset classes as
Mhm.
long as the expected return is positive
Love it.
and they're not one to one correlated.
So then another area I think that the financial professional can help on, and I'm going to have you expound upon this, is the long-term like odds in your favor, right? So helping with retirement accounts, tax efficient investing, and creating the consistent savings plan, something to kind of hedge against the work forever philosophy.
Okay.
So how would you be able to do that, right? How would you be able to help with retirement accounts or tax efficient investing or creating a savings plan, and I don't mean like in a savings account, right? But a plan that helps them to save for kind of the foreseeable future.
Got it. So there are everybody's heard of Monte Carlo. Well, not everybody, I should say everybody. Lots of people are
If you've
familiar.
listened to our podcasts, we've probably mentioned them before.
Correct. That's true. And also a lot of the custodians that are very common, so like Fidelity,
Yeah,
Schwab,
I already
Vanguard,
used them.
will offer you kind of free Monte Carlo analysis tools,
Hmm.
software that you can use and plug in your scenario and it'll give you a percentage and everything else. The big word. So basically, we use software. It's not
Hmm.
the same that they use, but it's similar enough to where we can still gonna be doing Monte Carlo analysis, and we would plug in all the variables of your plan, right, and all the expectations, all the goals, um, all the expenses that we can foresee, and then we would talk about the numbers, and more importantly, I think what they mean. Because some people are like they're shooting for like 100% on Monte Carlos, and I don't know if we want to go down that rabbit hole, but what we 100% of Monte Carlo scenario analysis, a lot of people are like, I need this. This is great.
Tell
It
me.
means that there's 100% chance that you will underspend your goals and your plan.
Yeah.
It means that there's 100% chance that I will basically have more money than but it's 100% chance that I'll have money when I'm gone, even if, that's not necessarily my goal. If that's not exactly your goal, then we would want to, and you're willing to adjust your plan, we want to keep you
Mhm.
within like a range.
Yeah.
So we look at Monte Carlo results as a good proxy for risk. So we want to think about that in terms of risk. Like if you have like a 30% probability of success with Monte Carlo simulations, maybe that's probably not great. Okay. But there are very many, interactions that we would or I'm sorry, relationships that we've engaged with that 50 might be completely sensible,
Correct.
right? Like they wanted to bounce the check to the funeral home. So if you want to bounce the check to the funeral home and you have 100% chance of success, you're probably doing it wrong.
Yeah, you're definitely doing it wrong at that
Yeah.
point. And I think that it's important. It's really, really hard to break the idea of like,
Yeah.
it's your money,
Yeah.
it's your finances.
People don't want to
You
think
want an
about.
A.
Yeah,
I want an A
exactly,
plus.
exactly.
So
People don't
it's
wanna think about
stressful
it.
to see 50% because you're like, oh my God, you're giving me this plan and
Mhm,
it's like a coin flip chance of working. And the answer to that is no. That's not what
no,
that
because 'cause you're gonna
is.
make adjustments,
Correct.
like, you're gonna make adjustments well before your theoretical car in
Yeah,
this analogy hits the
exactly.
wall. You're not just gonna not press
Right.
the brakes and accelerate into this wall
Yeah, it's
and just
it's
hit it full
weird.
speed.
It's a weird balancing game of like, okay, I'm putting my foot on the gas to go a little bit faster, like I could spend a bit more money. Okay, we pressed it a little too far for the climate that's here. Like, because the thing is, you can control your car, you can't control anything else, right? So if I'm pressing the gas and then it turns out that the road that I'm on suddenly like changes to be a lot more steep, I'm gonna start taking my foot off the gas a bit more. And so it's important because you know everything around you is changing and all you can control is yourself. So if you're
Mhm.
working with somebody consistently, they should be regularly looking at and having conversations with you to that end. Okay. And then protection against like the wild cards that come, right? So how CFPs in particular, since that's what you are, right, would build a strategy with safety nets like emergency funds, insurance, long-term care. Like how important is it to look at and make sure that those are there?
It's very right. So it's not necessarily important that long-term care exists. You might just want to self-fund it. You just need to have an idea of where your money's coming from for everything that you need it to come from, right? Like if you have capital expenses, if you want to buy a new car that's going to be 50K in a year or two, we need to know where that 50K is coming from. Where does it make the most sense from a tax perspective to withdraw it? Where does it make the most sense from an investment perspective, right? Like, and everyone, we're going to want to have an emergency fund. We want to have some fallback so that we're not paying interest at credit card rates essentially, right?
Yeah.
Like short-term borrowing rates, we're going to be 20% plus when we're only able to generate on average,
Mhm.
let's talk about like 7%, maybe 10% or 12%, even if we're going to go, historical S&P, if we're going to talk like 11% return on assets. And that's not, going to be
Yeah.
after tax. But the point is, if we're talking about those like we can get an 11% return on our assets, and if we need to borrow at a personal rate that's 20%, then we want to, or 20% plus,
Mhm.
right? Then we want to not borrow at 20%. The best we can ever do on average is 11.
Yeah.
Does that make sense? And that's if you're all in equities or the S&P. So, and the S&P's had a good run. I mean, everyone knows this, right? It's recently. So the idea is, yes, you want to have an emergency fund. Everybody's going to have an emergency
Right.
fund. You're going to have tax deferred dollars. You're going to have tax free dollars. You're going to have taxable brokerage dollars, and you're going to want to know exactly which you should pull from and why. So you want to have like a long term tax plan. You want to have an estate plan. You want to have a retirement probability of success analysis with ranges. So
Mhm.
like you don't want to have to adjust your plan every year based on the market movements. No,
Correct.
if your probability of success goes from like let's say 85 to 80, do you really want to cut your spending by like some percentage? Probably not. Like no, you
Mm.
just
You're still
ride.
in a really
Yeah, just
great
yeah,
yeah.
you're in a great spot. Just
Mhm.
just relax and enjoy the
Mhm.
ride. Like so the idea is that everyone's still at the wheel.
Mm.
Our eyes are on the road, and as long as there are no unforeseen outcomes, as long as we're not barreling towards this wall,
Yeah.
we're gonna make a plan that everybody's pretty happy with and can maintain.
And to that end, I think that it's crucial that whatever financial professional you're working with, like, there should always be a very open line of communication because you might be
100%.
somebody who freaks out about a bit about going from 85 to 80. So you're going to need to be able to talk to and have somebody that's
Mhm.
answering, walking you through it because that plan needs to be something that you are very, very comfortable with before
Right.
it's even put into effect.
Absolutely.
So it should be something that you are very well aware of and understand what it means and what the adjustments are when you would adjust well in advance.
Yeah, I've made the point in the past that J.L. Collins in his book A Simple Path to Wealth
Mhm.
actually made the point. I think it's a good one. Um, if you are the kind of person that when the market tanks 30%, you're going to pull out, you shouldn't be in the market.
Yeah.
Like you are actually literally like numerically, mathematically better served by just being in like a high yield savings account or treasury bonds, right? Like and just holding to maturity or something like something with incredibly low volatility, risk free, where you can just take your return
Right.
and move on. Okay. Because if you buy in at market highs and then it drops 30% and then you're out.
You're just
And then
giving
you
away
jump
money.
back in when the
Right.
market goes up 10, 15%, and then you jump out. You're
You're giving,
going to you're going to mistime the market.
you're going to lose money.
All the vast majority of professionals, I think it's 80%, don't maintain year over year their above market status. So if you look at like the top, whatever percentage, 10 percentage, top performers, top 100 performers,
Hmm.
for like hedge fund managers, portfolio managers, and then you look at it next year, 80 of them are gone.
Yeah.
So no one's doing this. Even the most highly paid, most successful people on an annualized basis, they're not repeating.
Yeah.
So you're probably not going to beat those guys that are getting paid, tens of millions of dollars to do this.
Hmm. That again speaks to the importance of having that emergency account or something like that because you don't want to find yourself in a position where you have to take money out during a down market.
Exactly.
So we would always want to make sure that there's a plan there.
You want to have a very
So
clear idea of how it goes, of
exactly.
how it's
So
going to go.
ultimately, I want to phrase your financial professional you're working with as your casino dealer who actually wants you to win. So anyway, to that end, I really think that you should be making sure that you are finding or working with some type of professional that will prevent your retirement from being like gambling roulette wheel, something to that end. So anyway, Eric, any closing thoughts?
No, I think this was great.
Beautiful.
All right. If you enjoyed today's episode, please rate, review, or subscribe to support the
Mhm.
show. And if you have any topics you'd like discussed or financial problems you would like solved, reach out to us at podcast@equilibriumfp.com or visit the website equilibriumfp.com.
Till next time.
Thanks, guys.